So thanks to everyone who's joining us. My name again is Sandra. I'm the principal broker with the Mortgage Center in Guelph. I'm just going to do a screen share here with you, and then we can get started. So today's webinar is going to be about 15 minutes. I will leave a couple of minutes near the end just for any questions. But if you do have any questions, you can certainly contact me through my website, and I'll share the screen with you guys here. So I think you can see that. Let's just make sure that I am sharing the screen. I think I am. Okay. So here we are, buyer and seller trends that we're seeing that realtors need to know. So, it's not anymore just a 5-year fixed rate and a 5-year variable rate mortgage. I very rarely get the call. What's your best rate on the market? I mean, we've got an excellent mortgage app. If you haven't already downloaded it, just go to our website at skipthebank.ca on the top right-hand corner. You can download the app. And you can see what's happening with mortgage interest rates in real time. And so what you'll learn today is some of the common mortgage financing trends that we're seeing right now that you should be aware of as a realtor. And then I'm going to also bring to your attention how to advise your clients. Now, of course, you guys are not mortgage brokers. That's my job to make recommendations to clients on mortgage financing, but you need to know a little bit about what's happening. So I'm also going to outline some of the things that you should be watching out for. And again, we're going to be about 10 to 15 minutes. So we're going to go through this information fairly briskly. The last couple of minutes, I'm just going to give you an idea of what's happening with interest rates because I'm sure you're curious. So the first thing that we're seeing in our office is alternative financing. Now, when I started this 20 years ago, one of the things that we were just starting to do is alternative financing. And I would say now probably 40 to 45% of the mortgages that we do through our office are through alternative financing. And so if you are working with somebody through a bank, what may happen, and we see this all the time because they probably don't, your buyers or your sellers don't tell you, or they may tell you, they may actually have a mortgage through a bank, and then they go to their bank and they've been declined. They're usually embarrassed about it, and they give our office a call. Just so you guys know also that as a mortgage broker, we actually do mortgages for banks. So we do mortgages for TD and Scotia, for example, but we have access to a whole bunch of different financial institutions. And what alternative financing is actually when there is a deficiency in one of the C's of credit and the borrower doesn't qualify for conventional financing or bank or prime financing. And it's funny, as I was reviewing these notes this morning, I have capacity on here twice. And I was kind of thinking about that's sort of funny because it shouldn't be capacity twice, but that is the main issue that we're finding right now is that with the new qualifying rate, so let's just say the 5-year fixed rate is at 6.5%. Borrowers need to qualify at a rate that's 2% higher than what they're getting on their mortgage contract. Remember, that's the stress test rate. So we're stress testing people based on an interest rate of 8.5%. There are some lenders that actually don't have the stress test rate. They are usually trust companies or credit unions, but they have different other criteria. So again, for example, like if the capital is coming from another country or the down payment on the purchase hasn't been in the person's bank account for 90 days, usually we have to do alternative financing. So capital is the down payment or the source of funds. Capacity, you guys remember this from Mortgage 101, debt ratios need to be in line with GDS of 39, TDS of 44. We do have some prime lenders that will do an extended ratio to 50%. And then I did want to talk to you a little bit about another financial institution. If you're self-employed, they will actually bring the TDS to 70%. If there is a problem with collateral, so the property that they're actually buying, it will be alternative financing. And I just completed a mortgage recently for someone was buying a rural cottage, or not a cottage, a rural property, a stone house that hadn't been updated in 50 years. And they wanted to put only 20% as a down payment because that's all they had. So what we did was we did alternative financing for them because financial institutions, when there is a deficiency with collateral, will require more money down. And if the borrower doesn't have it, the way to complete this is through alternative financing. Character is related to job stability. So remember, what we're talking about today is if there is a deficiency in one of the 5 C's of credit, your buyers or sellers, remember, if they are porting a mortgage, they are going to have to requalify. If there is an issue with character and that's related to job stability, it will be alternative financing. Now, the good news is we help lots of first-time home buyers, and many first-time home buyers they've just started their job. However, if it's in the same industry and even if they're in a probationary period, we can use a history of their previous employment. So, for example, if it's an engineer who's just started at a new firm and they're 2 months into their new employment and they're on a probationary period, but they've been an engineer that worked at other firms for the last 3 to 4 years, we can actually get that mortgage approved through a lender. But character is if someone is on commission sales, for example, they don't have a history of the commission sales, or if they started a new job that's not normally what they were doing, or if they've done retraining, and you will see alternative financing. So some of the clients that could fit into alternative financing is a single income earner with significant down payment. Now, what I'm seeing come through my office is more and more uh, borrowers are coming in purchasing properties with significant down payments as a result of a buyout from a divorce or separation, or maybe they've sold their matrimonial home. It is very challenging, even if you make good money for a single income earner, to qualify today for conventional financing because of the debt ratios and the qualifying rate. The other time is we do have a lot of first-time home buyers, or maybe a widower or a widow person who wants to move but only has one income. The other area where we see a lot of alternative financing is on student rentals. So we do work with a financial institution that will do mortgages purchases on student rentals, or refinances on student rentals, but the property cannot be zoned as a legal lodging house. So if it's a home like we're familiar with in Guelph, Kitchener, Waterloo, Cambridge, where landlord or a real estate investor purchases the property and they're going to convert it into a student rental, or maybe it's already a student rental, bank financing is not possible on these. So we do quite a bit of alternative financing for that. Multiple property owners also often require alternative financing just because their debt ratios are not in line. Many prime lenders do have a cap of somewhere between 5 and 7 properties for maximum properties owned. Let's just say the other area that we see is if somebody already owns a house and they have quite a high mortgage on the property and want to buy a secondary home, like a cottage, that is often alternative financing. And we've already talked about the fact that if the property needs work. The other trend that we're seeing, so the second trend that we're seeing in our office is mortgages for cash flow. Now, I don't know how many of you have heard about the Manulife one. It is a product that we do through our office, and we're having more and more people request this type of product. And I'm just going to do a stop screen share so I can explain how this product works. So it's a very unique and sophisticated. So right now we're talking about the Manulife One operating line of credit, and it is a more sophisticated product because how it works is instead of the mortgage being an amortized mortgage. It's a secured line of credit that has a bank account attached to it. Now, no other bank has this. TD doesn't have it. RBC doesn't have it. Scotia doesn't have it. I know. And the bank account is attached to the secured line of credit. So what ends up happening is now instead of the borrowers putting their money into their bank account and paying their bills, their pay goes directly into the operating line of credit. So they're prepaying the mortgage, and then they're also then paying their bills from the operating line of credit. Now, this is an excellent product for a certain group of people, especially people who want to pay down their mortgage or want to purchase other properties. Or if they've come to me and say, hey, you know what, I'm going to be going on maternity leave, or I'm going to have some disruption in my income, I'm going to be self employed. This is the kind of the strategy for them, because what they're asking for is for cash flow. So some of the people that would fall into this category, or some of the kind of the little tips that you would hear from people. Give me a second here. So clients which would fit the Manulife One which clients would the Manulife One benefit? So self-employed individuals who have lots of equity in a primary residence and want to leverage it to purchase other properties. And I think you recall me saying at the beginning of this presentation, Manulife with good income, with good credit and good equity, and they've demonstrated good financial stewardship, they will actually bring the total debt service ratio to 70% on this. This is an excellent product for real estate investors who have small or no mortgages on their homes or on their primary residence and want to gain access to equity to purchase other properties or maybe lend money. For this product, they require strong income, net worth, and good credit history. So again, it's a very niche product, and it apply to a certain market. So this isn't going to be for your self-employed individual who doesn't do their income taxes on a regular basis and has so-so credit. These are very strong borrowers. The other trend that we're seeing through our office, and this is something just to kind of wrap up this part of the presentation before I talk a little bit about interest rates, is reverse mortgages. And you can actually have a reverse mortgage. Your minimum age is 55, which is kind of interesting. I'm sort of almost in that category. But I often get, so more and more people are retiring and have a mortgage that they haven't paid off. And we're going to continue to see that trend. I think the Canadian Home Income Plan, which is a reverse mortgage that we can source as mortgage brokers, was saying something like about at 65%, at 65 years old, people are generally retiring on average with about $100,000 to $120,000 mortgage. So the other challenge for people for financing when they're in retirement is that they don't have the same taxable income. So the good news is that there is no income or credit history requirements. How people qualify for this type of loan is based on the loan to value. The loan to value is based on location, value of property, and age of borrower. I am doing more and more of these types of loans for people who are in their late 60s and early 70s, because again, the loan to value increases as they get older. And if they're buying a property in the major urban centers, so like Kitchener, Waterloo, Guelph, Milton, the loan to values are based on the location. If it's a rural area, the loan to value will be less. So some of the things that you want to look for and opportunities to help your clients, which I find are often overlooked, because I get calls from buyers saying, I'd like to move, but I'm not sure how to put together the financing. So if you have somebody who's buying and selling and they want to purchase first and then sell their house later, so they're downsizing, I am doing more and more of these reverse mortgages for people who are gifting money to family members as an early inheritance so they can get into the housing market. I have done reverse mortgages too for people who own multiple properties and want to access the equity to either purchase a cottage or even just another rental property for cash flow purposes because reverse mortgages are very interesting. You can make payments on the property, on the mortgage, or you can defer the payments. And when you sell the property, then that's when all the payments are made. So they're very flexible products. They are becoming more and more popular. And if you want some more information about that, I'm happy to provide that. So let's look at mortgage. Let's change gears a little bit and talk about mortgage rates. As you guys know, inflation is the Bank of Canada is going to make another rate announcement later this month, October 25th. We're when I was at the conference this weekend, people were saying 50% increase, 50% no increase. So something will happen later this month with interest rates, but I think what we need to focus on is what's going to happen after that. And what economists are saying is that the Bank of Canada has overshot with the increase in the interest rates, right? So they've just pretty much been following the Federal Reserve on what they've been doing with their interest rate hikes. But our economy is a bit different, and the way our mortgages are structured are a bit different. So the Bank of Canada has actually more power in Canada than the Federal Reserve does, especially as it relates to the CPI. Because as you know, inflation is a lagging indicator, and how they measure that is through the consumer price index. And the mortgage loan amounts don't have an impact on CPI, but the interest payments do. So that's one of the reasons. So we're starting. Inflation has, and there are other factors. I'm not going to get into that. I have a webinar on the YouTube channel that talks all about that, but not to get too far into the weeds. So we are going to see consistently high rates, probably for the next 12 to 18 months. Where we're going to start to see some rate relief is probably the middle of 2024. So, sorry, 2000 middle of 2025, possibly. Sorry, I was hoping it was going to be 2024. It's probably going to be another 12 to 18 months because the Bank of Canada is going to have to hold interest rates at a high level in order to kind of cool inflation because inflation is still very hot. So what's happening with interest rates? Let me just kind of show you a couple of rate sheets just for your interest so you can kind of get a gist of what we're seeing in the marketplace right now. So this is an email that I just received. We do mortgages for MCAP. They're one of our wholesale banks. You guys can kind of see where interest rates are. Let's just see if I can increase this somehow. If you can't see it, I can read it out to you. So let's just have a look here. Try to zoom this up for you. Here we go. So you can kind of see here, remember, there are different categories of mortgages. There are insured mortgages. There are insurable mortgages. This is for purchases or transfers for under 25-year amortizations. And then there's uninsured mortgages. So this is on the prime side. So you can kind of see here what's happening with fixed rate mortgages. There are some specials. So for example, shorter terms, people are starting to think a little bit more about shorter terms. Shorter terms are almost all close to 6.897%. So what we're recommending in our office, if you're going to go with a shorter term, why not think of a variable rate mortgage? Because the interest rates are also a little bit better on variable rate mortgages than shorter terms. Okay, so this is from MCAP, and you can see that was the rate sheet from Monday. We do all, as I said, we do mortgages for TD. TD has had a long-standing cashback product where if the borrower decides to run their mortgage payments through a TD account, they are eligible for some cashback. Some people that doesn't motivate them or they don't want that. They want to kind of keep their account separate from their mortgage. But what I wanted to show you here is sort of what's happening with interest rate with some of the banks. So you can kind of see here that, oh, so, so sorry. It's actually my sales rep sent out a rate sheet. This was the rate sheet from September the 15th, 2022. So what I can tell you is TD's rates are just about the same as every other financial institution. But it's kind of interesting to see this rate sheet. You can sort of see where 5-year fixed rates were. And then again, with the variable rate mortgage, TD Prime is a little bit higher than all the other banks' prime, but you have TD Mortgage Prime minus 40. So they're in line with every other financial institution. So that kind of gives you an idea of what's happening with mortgage rates. And so we are wrapping up for the afternoon. I should say the morning. I'm just going to close this. And I wanted just to let you know, like we love working with real estate agents. So if you have any questions, please reach out to me. The best way to do that is just to go to my website at skipthebank.ca. All my contact information is there, and you can also schedule an appointment with me. There's a button at the bottom right-hand corner. And again, you can just click it, schedule an appointment with me, and I'm happy to review any situation that you have. And I'm always love working with realtors and acting as a resource. So thank you. Have a good day in business and go sell a house.